U.S. inflation is hotter than expected, and the markets are confused, unsure of what to do. At least that's the message that we are getting here from stocks, currencies, and perhaps the bond market. So what do we make of all of this, and what does it mean going forward? See, turns out it might be a deeper and more interesting story than meets the eye. We're going to try to unpick it here on Macro Money. This is Ilya Spivak, head of global macro here at Tasty Live. And the sort of price action that we got from these numbers today, understandably confounding for the markets. We can sort of clearly see in the response across the major asset classes just how confounding it was. But the upshot might well be something that is much more insightful than it appears at first blush. And that's what we're going to try to unpick here as we look at what the internals suggested and how that might actually line up with what the markets ultimately did, and then what they might do next. So, first, the results. The headline inflation number higher than expected, 3% versus 2.9% expected. The core reading also higher than expected and actually up versus the downtick that was anticipated. Markets thought we'd come down from 3.2 to 3.1, and we instead went up to 3.3. So all the way in the opposite direction. So not surprisingly, at the first look here, what we have is an ambiguously higher set of inflation numbers than anybody banked on. And the response from bond markets really makes the most sense. We have a sharp move higher in yields, sharp move down in the bonds. We can see this is the continuous contract for ZB, the 30-year rate. It ends up seeing the most damage. Things are more contained at the front end of the curve, and the 10-year ultimately looks more like this, but suffers a smaller decline in percentage terms. This is really where the bleeding is. The market's apparently saying, oh, well, hotter inflation means the Fed will have less room to cut rates looking forward, and that's how you end up with rates surging in bonds, dropping back into that. We can see that inflection zone around the 113 area on this ZB benchmark. So this part of it makes sense. Higher inflation, probably less of a dovish Fed, so rates go up. This much makes sense. What's interesting is what then happens in stocks and in currencies, because it ends up being a very different story. Stocks initially lurched lower. That's not surprising. You can see that right here in this latest candle on the continuous S&P 500 futures contract, the ES benchmark. But they ultimately come back in and erase most of those losses to finish the day down, but only by a whisker. It is a even more dramatic story for currencies. But before we go there, just the main takeaway here still, the range that has held since early December, it holds. And we haven't gone anywhere still. About the only thing we've seen happen is that since that DeepSeek shock here, we've continuously set lower highs. So a lower high from the DeepSeek spike, a lower high after the initial tariffs to Canada and Mexico that didn't really happen spike. And so we seem to be kind of inching lower, but nothing is really happening. And equities did not find in this CPI report what looked like, at the very least, a convincing catalyst for deeper losses. Nevertheless, we also don't find a catalyst for convincing gains. So is it that the market is shrugging off higher inflation? Or is it that the market saw something else here that maybe wasn't the initial reason to get spooked, and not the reason that the bonds did what they did right here, but something else. And we'll try to see what that is. The response in currencies likewise suggesting something else might be happening here. Take a look. With higher yields, the natural expectation is that the US dollar would grow stronger because its yield advantage against other currencies would be bolstered. And indeed, just as we had an initial spike in the stock market lower, we had an initial spike in the US dollar higher. This is a chart of the euro as a kind of benchmark, most liquid version of the dollar's value, and a kind of benchmark for what the dollar does on average against most currencies. As a matter of fact, the DXY, the US dollar index, is overwhelmingly skewed to euro in the basket because many of its legacy currencies that initially made up the dollar index are now the euro, like the Deutsche mark or the French franc or the Italian lira. And so this is a good sort of barometer for overall US dollar performance. And ultimately, we see the US dollar actually ends the day a touch lower. It does rally, but as stocks reverse course, so too does it. Now, we should point out there's the exception here. The Japanese yen is significantly lower against the dollar today, and that's the most bond market adjacent, the most yield sensitive version of the dollar's expression because of the unique characteristics of the yen, whereby it's basically just a play on US yields. But outside of that, the dollar clearly much weaker than you would expect, and stocks more resilient than you would expect if you came into today, as apparently most markets did, with the idea that hot inflation and fewer Fed rate cuts is bad news for sentiment and good news for the dollar. Because indeed, those were exactly the initial reactions, and both faded over the course of the day, despite the bond market looking rather unambiguous. So what was this all about? Well, it certainly wasn't about diminished Fed rate cut odds, because they have become somewhat diminished, or at least somewhat moved around. So we can see that we are down to a single rate cut for this year, 27 basis points. The markets aren't even trying to flirt with the idea of two. The Fed, of course, said that there would be two, or at least that's the median forecast of Fed officials as of December. The markets have questioned that, but here the verdict is quite clear. For next year, the situation has become a little bit more dovish. So we've gone from about 17 basis points being baked in for next year to now a full cut on the menu. What's interesting is that the upshot has changed very little. The overall rate cut cycle being baked in over the course of this year and next has only narrowed in by about 2 basis points. It was 54 basis points in total yesterday. Before this data, it's 52 basis points now. No big changes. The markets are still very much off sides relative to the Fed. The Fed thinks that it's going to do double this. But the markets think that the mix of when the cuts are coming has changed a little bit. Fewer this year, a little bit more next year. But ultimately, only 0.5% is still only 0.5% yesterday versus today. So what might explain this? Well, looking at the internals of the report, you start to see what might be going on. So here's your headline number, 3%. It's a little bit higher than expected, which was a hold at 2.9. Here's the core number going up, 3.3 versus 3.2, and the expectation was that it would go to 3.1. Now, let's consider here what the biggest contributor to inflation is. And not surprisingly, it is the service sector. If we very quickly look back at how this has evolved, we can see what this looks like coming out of COVID. So we can see here's the onset of COVID, and initially energy completely falls off the map because the global economy is effectively closed. And then once you get the reopening, energy surges, and it is, of course, helped along by the breakout of the war in Ukraine and the adjacent energy shock in Europe. Then goods inflation starts to pick up as you get reopening from COVID and those supply chain disruptions from the pandemic really take their toll. This is the part of the complex here that the Fed was calling a transitory inflation that was likely to go away by itself. And indeed, it already started to do that before the Fed even started to cut and or hike rather. And indeed, there we go. It's already whittled down to next to nothing by the end of 2022 going into 2023. The same thing happens to food inflation. This is another global supply chain disconnect sort of a story. Here you get this big build in food costs, but then again, as you get those supply chains normalized, it goes away. Where inflation is left is the service sector. This is where the Fed perhaps miscalculated on its transitory idea. As we've argued then, and as we continue to argue now, this is mainly a story about the cost of labor being sticky. And when people get big wage jumps or are hired coming out of COVID when labor is still scarce and people are reluctant at a heavy premium, those costs don't adjust back down as easily as floating costs for food and goods and things like this. Those costs are locked in unless there is some sort of a mass reset of wages. And of course, that means layoffs. And we've seen some, but not nearly the kind that would bring us a meaningful rise in the unemployment rate, which has not materialized. So this is where we are. Most of the inflation is in services, and indeed most economic growth is in services. Now let's look back at these contributions. The inflationary contribution from that critical service side actually declined in this report. And the food component was completely unchanged. The real difference, the real way we ended up with these hotter numbers, and by the way, that's including core, is that we got a readjusting in goods that seemed to rebase from a bigger negative contribution to a smaller one, and a rise in energy. Now, this is, of course, the core, so how in the world would energy end up here? Well, transportation services are one of the biggest reasons why core inflation is hot here. And, of course, an input into transportation services is the cost of fuel. So what happened here was mainly not the kind of thing that would spook the Fed. And as a matter of fact, what happened here was a weakening of inflationary pressure in what is singularly the most important engine of U.S. economic activity, the service sector. Now, what this rhymes with in a most unwelcome way for U.S. economic growth is the set of purchasing manager index numbers that we got last week from both S&P Global and the Institute of Supply Management. Here's the S&P Global version. It's a bit more dramatic. We can see that January gave us a dramatic slowdown in service sector activity growth. That, of course, would rhyme with diminishing inflationary pressure as demand eases. And so you end up here then with the weakest service sector growth and then the weakest overall growth, the composite index here, in a year. As ever, these numbers signal growth above 50, signal contraction below 50. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So that we are going from higher 50s to lower 50s here means we're still getting growth, but at a much slower rate. The ISM set of numbers, not quite as dramatic, but pointing in the same direction. Service sector expectations were 54.3, so higher growth than what we ended up getting, which was 52.8. Now, this is a set of numbers taken together with the CPI report that starts to paint something rather ominous. And the reason that it is because, as we've seen before, global growth is primarily made possible by three economies: the US, the Eurozone, and China. They account for 58% of global GDP, and the remaining 42% are, for the most part, vendors that depend on exports to the former three to have demand and to have economic growth. So the critical engines here are these three economies. And what we've seen, certainly since the, let's call it, latter part of the first half of last year, going into the middle of last year, is that the US, until January, has vastly outperformed, while the story in the Eurozone and in China has been of deceleration and most recently of standstill. These readings at 50, they're not quite contraction, but they essentially amount to nothing moving. Whereas what's happened in the US until January was very robust growth, and only in January do we see this downtick. Now, if the US is such an important part of the whole, why is it that all this US outperformance is not spilling over and feeding these vendor economies and feeding China, which in the case of the US is certainly a vendor economy as well? Well, it's because most of the demand is in the service sector, where most of the providers are domestic firms. Meanwhile, the situation in goods is essentially a goose egg. There is really no demand pull there, hence the inflation numbers being basically non-existent. It's the same story told through a different visual here. This is where demand is. This is where demand isn't. And what the US mainly does on the import side of things is goods. And what it mostly services domestically is services. And so the US resilience of last year really didn't spill over. In fact, so much so that even Canada is in dire economic straits, and 80+% of everything they export comes to the US. They, of all economies, should be swimming in economic fortune with the US this strong. But they're not. And it's because the US is largely keeping its growth to itself. What this also means is that the three major engines of the global economy have been whittled down to one as of last year, because clearly the Eurozone and China here are at standstill. And the troubling part of the CPI report is that even though the headline is high, the internals suggest that this most critical piece, the U.S. service sector, is now suddenly weakening. And the upshot from these PMI numbers a week ago seems to be finding some reinforcement. That, of course, is not just bad news then for the U.S. economy downwind, it's also bad news for the global economy overall, and could explain why stock markets, even though we got this rejiggering of Fed policy odds and the bond market clearly noticed, why stocks could not mount a lasting rally and could not find encouragement, even as they could not find a lasting sell-off catalyst, because these were not inflation numbers that suggested anything positive for growth, despite the fact that they suggested that the Fed is not in a position probably to move a lot in the near term, something that Fed Chair Jerome Powell has been telling us in testimony in Congress, both yesterday and today, never mind the January FOMC meeting and before. It's also why we might have a U.S. dollar that isn't reveling in higher yields. This does not portend those higher yields holding. So the next inflection point here then becomes all the more interesting. And that, of course, is Friday's retail sales report. We're expecting to get a decline of 0.1%. That would be the first negative reading since back here, middle of last year, but generally within the bounds of recent dynamics. Where this becomes particularly interesting is if, in fact, services as powered by domestic U.S. demand are starting to fade, and indeed U.S. domestic demand is starting to hit a roadblock, well, then this ends up looking like a much more ominous set of numbers than meets the eye, despite the fact that most U.S. economic data, according to analytics from Citigroup, has tended to come in broadly in line with expectations. We can see when this index is at zero, it's basically realized results are matching forecasts for the most part. Now, if this ends up looking differently, and we end up seeing perhaps a downside surprise on this retail sales data as we move forward here, and it ends up showing us that indeed U.S. consumer momentum is easing, and this is how we end up with services weaker, then the story is bad news not just for the U.S., it's bad news for the global economy, because to the extent that services is what powers the U.S., and the U.S. is the last pillar of the global economic pie with any strength for most of last year, the U.S. service sector is really, and the U.S. consumer is really the shoulders upon which the entire artifice rests. And there is something to be concerned about because, of course, we've just seen last week the markets react violently on Friday to the University of Michigan Consumer Confidence Survey that showed a dramatic decline in sentiment as inflation expectations have surged. So when we look at this, we end up with essentially the worst of all possible worlds. If consumers are getting defensive, and incidentally, the respondents in this survey mainly cited tariffs as the reason for the jump in inflation expectations and in their commensurate turn south on sentiment, we end up with a world where inflation looks stickier, but for the wrong reasons, not because of robust demand, but because of a repricing of inputs. Meanwhile, confidence is fading in the one part of the story where you don't want it to be fading if you are concerned with U.S. growth. And the story ends up looking like a confirmation of this, a deceleration of the business cycle in the one part of the landscape you don't want it. And so if then these retail sales numbers surprise on the downside, the consequences could be quite dire indeed for stocks. The U.S. dollar may weaken further, and the bond market may have seen its last big downtick in a while. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what may follow. I am on with Chris for Futures Power Hour Mondays and Fridays, on with Victor Jones for The Price of Truth on Tuesdays, back with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Happy trading.